Joining me, my pleasure. Welcome back on the show is economist Jeff Lacker, former president of the Richmond Fed, senior affiliated scholar with the Mercatus Center at George Mason University, and a member of the Shadow Fed. Is that your garage band?
No, formal title, Shadow Open Market Committee. It's a great organization. I'm really honored to be part of it. It's a group of 11 economists, mostly sort of academic, and a lot of former Fed officials that offers an independent, critical, constructive review of Federal Open Market Committee actions and policies.
So, how does it feel being out of the central bank system? I mean, do you have to pay a toll on the downtown expressway? Do you have your
No,
own private circulation of $2 bills? I always wanted to ask you these things.
No, I'm kind of nobody now, as far as they're concerned, which is fine. I have friends back at the Fed, so I keep tabs on what they're up to and what they're going through. It's boy, going through the pandemic, my heart went out for them. I was at the Fed during 2008, 2009, and have a sense of what kind of crisis mode within the Fed feels like. And so they had their hands full in 2020. And then 2021, 2022, I was just kind of baffled about why they sat on their hands for so
For so
long. So,
long, which we'll get into. I would
yeah.
like to ask you about the president. I'm going to invoke, we just finished with Passover. What makes this monetary environment different from all other monetary environments? I want to ask.
Uh,
Well, for one, moral hazard, all those other things are out the window. This third rail that you're not supposed to touch about Fed independence. Surely you're watching
yeah.
the news. President Donald Trump and his own appointee, Jerome Powell, chairman of the Federal Reserve, he's out there actually, jawboning him, insulting him daily, liking him, not liking him. I have
Yeah.
never, at least in my market adulthood, witnessed anything like this.
Yeah, it's fascinating to watch. So first thing to note, from my experience, people inside the Fed are well capable of screening it out, putting it to the side, leaving it out of their minds, and putting their heads down and focusing on the data and analytically working through just what they think that means for what they should do. I don't think it's going to change their decisions one way or another in the coming year. But having said that, it's not helpful, and but it's always been the case that politicians, political leaders, criticize the Fed from time to time and carp on them. Fed independence is this subtle thing that's ebbed and flowed over the history of the Fed. What we have in place now is a system there's legal arrangements that insulate the Fed, but more important are the political norms around Fed independence. And the big one that we sort of got to in the late '80s and early '90s was that the president would, and the White House and the administration would leave the Fed alone to do monetary policy to the best of its ability and using its best judgment. But we weren't always there. So in the '60s and '70s, part of the really terrible experience with inflation in the 1970s was the result of direct political pressure on the Federal Reserve. First by Lyndon Johnson in the mid 1960s. And that's a fascinating story. In 65, 66, there were the Great Society programs, Medicare, Medicaid, the war on poverty. And then along behind that came the buildup in Vietnam, which involved a lot of Fed spending. Johnson, however, was reluctant to go to Congress for a tax increase to pay for the extra spending. And so he didn't want to do that because he was afraid that congressmen would shoot back and
I can
cut
imagine the
his war on
conversation.
poverty.
How about you print me some money? No.
So, but at the same time, he wanted the economy to
Yeah.
be robust. He wanted unemployment to continue to come down. So he was constantly pressuring the Fed to hold off rate increases. So it was an environment where inflation was pretty low, under 2%, but the pressures were bubbling up, and the Fed needed to take action. One cataclysmic, pivotal moment in late 1965, the chairman, William McChesney Martin, had held off for the whole year with the administration pressuring him not to raise rates. He raised the discount rate in early December 1965, and Johnson immediately summons him to the his ranch in Texas where he had been recovering. He was recovering from gallbladder surgery, and when Martin gets this is unprecedented, calling the Fed chair to the Western White House and raking him over the coals. He yelled at him. He excoriated him. I mean, one account says he pushed him up against the wall, and then there's this famous picture of him, Johnson, in the driver's seat of his white Cadillac convertible with his Secretary of Treasury on the right and Martin in the middle. And you remember those old boats, these old cars in the 60s.
Yeah.
There was a bench seat in the front. You could sit three across.
Right,
And
right.
then there's Martin looking very, Fed chair looking very uncomfortable. And he was about to be given Johnson's trademark treatment of a ride over these bumpy, rutted ranch roads in Texas with the Secret Service flying behind them in tow. So it was a major effort in intimidation.
So
Well,
The Federal Reserve itself is a little more than 100 years old right now, right? I mean,
that's right. So
this is
founded
not
in
enshrined in our Constitution. It wasn't put there by the founding fathers. In fact, there was this argument with Alexander Hamilton and the others, and the kind of the need for a central bank and debt, if I remember correctly from
That's right. So the
high
Constitution
school
gives
government.
Congress the authority over the value of coins and money,
Hmm.
and it's that authority that entitles them to sort of delegate to the Federal Reserve that responsibility over monetary stability, over the price
And
level.
there's that dual mandate of you want unemployment low and you want price stability. In a perfect world, you
Right.
would have the Goldilocks economy, not too hot, not too cold. Clearly, we had an inflation visited on us in 2022 coming out of the pandemic. And we'll talk about these things. I mean, PPP, all the extraordinary fiscal and monetary intervention, zero interest rate policy. And that is very difficult to put back into the bottle, if you will.
Yeah, it is. The Fed really struggled with that, and it struggled with both sides of what you call the dual mandate. So in 1977, the Congress has over the time given the Fed responsibility, told all the agencies in Washington to try and do as good as they can for the economy. But in 77, they gave the Fed particular instructions to conduct monetary policy in a way to ensure price stability, maximum employment, and then there's a third one, moderate longer term interest rates. Now, nobody talks about moderate longer term interest rates because everyone realizes that longer term interest rates build in an inflation premium. And the best contribution of the Fed to moderate longer term interest rates is to keep inflation low. If inflation's low, longer term interest rates are going to be low as a result. So the employment side of the mandate says maximum employment. That's a little touchy because the Fed can't um, push employment around in a permanent way. It can knock it off course for a quarter or two, but over the course of several years, it can't make employment larger or smaller than it otherwise would have been on average. And
But
that's
in fairness, if I were to get a couple of beers into Jerome Powell right now, the chairman of the Federal Reserve, and say, would you trade marginally higher unemployment for lower prices? Right now, they're having a hard time getting at their target of what 2% growth, which might potentially, mayhaps, make them more comfortable for more interest rate cuts in the future, and hence this impasse with the White House.
Yes, so it's certainly the case that in the short run, over the course of like the coming year or so, one could get better employment by tolerating higher inflation. Or on the other side, one could get inflation down, but maybe at the cost of a little bit of real growth. And the way it works is that by raising interest rates, you encourage people to save more and spend less now. That lowers demand pressures now and lowers the pressure on prices now. So yeah, and now the situation now, the narrative is they had this burst of inflation in 21, 22. They got behind the curve. They blundered, and I think they are well aware that in hindsight they made terrible mistakes. I think a case can be made that even knowing what they knew then, they were making a mistake in real time, and a lot of people called them out for it in 2021. But they've gotten inflation down from 7, 8% range down to 2 and 3/4 last year, but their progress stalled out. I think they cut interest rates a little too soon last year, but progress seemed to be stalling out. as we came into this year with inflation about 2.8%. Then on top, now you have all these very highly unanticipated tariff policy announcements, a tremendous amount of volatility, and all bets are off on inflation. I mean, there will be an impetus if these large tariffs go into effect. If we do the 10% across the board and the tariffs on China, if those go into effect, there will be price increases. Inflation will rise for a time. Now, the big question, the $64,000 question, is that going to be transitory? Because you might think, well, after the tariffs go in and they stay there, if they stay there forever, well, then after that, inflation doesn't have to be any higher than it otherwise would be. There'll be a one-time level effect on prices, but then the rate of change of prices doesn't have to be
Well,
higher over time.
Jeff Lacker, former president of the Richmond Fed, aren't you kind of split? Isn't this splitting hairs? I know they scrutinize the numbers. There are people that look at deflator numbers, leading indicators, lagging indicators, qualitative, quantitative things. I think the fundamental asymmetry here, whether you get it, prices at 2.5% or 2%, is that the president can almost unilaterally, the White House, the federal branch of the government, can throw the economy into disarray, thus forcing the hand of the Fed. I mean, there's an American exceptionalism, as I say. The most important finance metric on the planet is the Fed's main interest rate. It's hardwired into everything. And
Yep.
if things go to hell in a handbasket, as you saw that happened very rapidly in 2008, it happened very rapidly in 2020 with the pandemic. The Fed only has so many tools. It kind of has to slash. And that's the asymmetry of it. You can say that, well, it's not just me, it's the open market committee, it's the data that we take in. We're very deliberative, we have disagreements. But do you see what I'm saying? It's like one side is saying, I can throw everything into disarray and force his hand. And if I don't, he only has a year left on his term anyway.
Yeah, so the Fed plays its hand, given the hand that everyone else's plays. So the economy rolls along, productivity innovations come along, capital spending, demand, preferences, technology all evolve, and then on top of that, there's fiscal policy that has a big effect on the overall balance of demand and supply, but also has microeconomic effects that can gum up the works and really mess up economic conditions from time to time. So we saw that leading into 2008. There was a housing policy provided a huge stimulus to home mortgage lending, which provided a big stimulus to housing, which led to a lot of overbuilding and then a retrenchment when we reached the limits there.
Could you
Similarly,
imagine, by
here,
the way, the very idea of housing overbuilding? We're just 15 years removed from that, but nobody believes
I
me.
know, I know,
Younger Gen Zs, millennials don't believe me that actually happened. That
yeah,
we had a
yeah, for
glut of
sure.
housing.
Yeah, but today, yeah, these tariffs are something the Fed can't control. It's out of their hands, and they've got to react to. And so the White House plays its cards and does what it wants and can get away with on tariffs. There's going to be a lot of lawsuits for sure. The litigation's going to go on for a while. But then on top of that, the uncertainty about Washington policy. These tariff policies have drastic and material effects on the allocation of economic activity. What firms are going to be profitable? What industries are going to be profitable? Should I close down my business, get into some other business that's protected by a tariff, better protected by a tariff? The sectoral reallocation of resources is potentially large, but there's this lack of certainty about what the configuration of things is going to be like in a year. That all by itself, just sheer uncertainty about the lay of the land a year or two from now, is going to cause people to hold back on any discretionary, irreversible outlays that they couldn't get their money back, right away. So plant and equipment, hiring commitments, durable goods consumption, there's a danger. You see the consumer sentiment indexes falling. You see business sentiment indexes, weakening. There's a risk that we're in the midst of a kind of a freeze in discretionary spending. And going back to '08, in coming into like Lehman Brothers weekend, we had a garden variety recession, a recession that was tracking in terms of employment all the other recessions we'd had in the post-war US, it was in after Lehman, people just didn't know what was going on in Washington. And there was a huge pullback in discretionary spending starting the fall of '08.
And
And that's what pushed us,
I
and
felt
that's
that
what made it deeper.
I felt that similar weightlessness. Correct me if I'm, this is qualitative, in that second week of March 2020, where you
Yeah.
knew school was being canceled. You see
Yep.
NBA, you'd see all these extraordinary measures. People were fist bumping, were slathering Purell on everything. And I'm trying to think in my econ and history playbook, uh, we can only study 1918 and 1919 so much. I mean, the Federal Reserve back
Yeah.
then was very new. The economy was a sliver of its present size,
Yeah.
but you saw crazy things happen. You saw bond yields in the market reflecting fear and a rush to safety plummet. You saw the Fed come out as everybody was terrified and unemployment was spiking. I mean, to the double teens, in the mid teens in 1 week, the Fed taking rates to
Yeah.
emergency levels. My question for you in that moment, and nobody could have said, we'll be past this. They're going to be variants, but this is a great time to buy a house. It's a great time to get into risk assets. It's a great time, X, Y, and Z. I'm thinking to myself, business interruption insurance. And I know this is wonky, but effectively, Washington came out and nationalized insurance. And I think about PPP and I think about all the small businesses and larger businesses who did the right thing and they took the check and they protected payroll. And then by the time things normalized, they had a lot of working capital. They had a lot of money in the bank going into 21 and 22. Did the Fed not account for all that extra money in the system? Do you see where I'm going?
Yeah, I do. So, the dilemma policymakers had was it was clear that we were forcing supply to fall. We were forcing people to stay at home and forcing businesses to shut down. It was clear at the same time that people weren't going to voluntarily spend as much money. So you have demand and supply both falling, which is falling more. Um, the measures Congress took, the insurance measures, I think put a line under, put a safety net under falling spending. For I should say falling income. So it did a lot to ensure people's incomes didn't fall so much. So then, but the pandemic and the spread of the virus and the fact that it wasn't safe to go to restaurants or do a lot of things or travel, that kept spending back until the spring of 2021. And then after that winter wave faded, people came back, businesses opened up, you had schools, back
But
online and everything, and then the
anecdotally,
spending roared back. You'd have buffered their income, you'd written them checks and sent them a lot of money, and the spending came roaring
but
back.
anecdotally, wasn't there still a lot of money left in bank accounts, as evidenced by
Yeah,
what you saw in
yeah,
2023 with bank failure?
absolutely.
I mean, this is where I want to know: is the Fed looking at that? They do stress test
Yeah,
and they come out, but
yeah,
I hear anecdotally from small business owners. Let's say an owner of a wine and cheese shop who did the right thing and took that money. Uh, Payroll came back. They were able to deliver wine. They actually had a 3x year in 2020, and they had this money, right?
yeah.
Which was in the system,
So,
which was forgiven. So who is accounting for that? We were talking about the
mhm.
fiscal stimulus checks and the $2,000 checks that went out, but this is a huge second deluge of cash that's still in the system while the Fed has rates at zero.
So here's what it seems like happened at the Fed. So by all accounts, the March 2021, so a year later, the last wave of stimulus checks go out. Um, it's clear in the monetary aggregates. It's clear that bank account balances have ballooned. It's clear that household finances are unbalanced in the sense that their financial assets have gone up, but their spending hasn't gone up yet, and it looks like it might be about to. If you look at the Fed's forecasts, which they publish quarterly, their forecast didn't vary much. Their forecast in June of 2021 didn't seem to take that on board, and they thought the inflation picture was very mellow. And I think there's sort of two intellectual errors here in hindsight. One is it had fallen out of fashion to pay close attention to monetary aggregates because in in the past, what had happened in the 90s and the 2000s is that the variations in money growth were small potatoes and worth sort of setting aside. It was kind of dominated by noise and didn't really, the view was
But
that it
this
didn't
was
provide you much.
substantial growth in the money
But this
supply.
was very
Yeah.
substantial. And the other thing is this idea about maximum employment, and it has to do with the relationship between employment and inflation. So the idea that was around is that, all right, maximum employment means 4% unemployment rate.
Yeah.
If the unemployment rate's above that, there's slack in the economy, and I'm putting air quotes around that. That is to say, there's unutilized resources which will prevent a surge in inflation because there's unused resources to be drawn into the labor market and drawn into
Hmm.
production. It didn't turn out to be true. I mean, full employment in March of 2021 was probably around 6%, around where the actual unemployment rate was. So there wasn't as much slack in the economy in the second quarter of 2021 as they thought. So it was like two analytical errors, and ways in which their analysis sort of didn't catch it. Then in the fall, inflation's surging. They've they've been thinking and placing weight on the hypothesis that it was driven by
Transitory also. Yeah.
special supply chain disruptions that are going to pass. That didn't turn out to be true, and all their sort of historical correlations told them that they should be raising rates in the summer, and they held off. And there's a bunch of reasons they held off. We can talk about them if you want, but for various reasons they held off. And it wasn't until like November that they figured out they really needed to move rates. And then they had this. They'd promised people they wouldn't raise rates until they stopped tapering asset purchases. So you can debate the asset purchases, and there's legitimate questions about whether they were needed. That program was needed in 2020 when they launched it, purchasing treasury and securities and agency mortgage-backed securities. But then they promised they'd warn people before they started tapering, and they promised that they wouldn't raise rates until they stopped tapering. When there's no real economic reason you have to do it in that sequence, but they promised that sequence, and we're very concerned about. Now, their statement includes like an escape clause, and they didn't really
Act on it.
take advantage of the escape clause either. So anyway, looking, you asked me about what it's like on the outside. I felt bad for my colleagues in there. I was wondering why there wasn't more sort of public differences of opinion being aired. I was wondering if they were getting, and we won't know until the transcripts come out in a few years, what actually was going on behind the scenes there.
In defense of the Federal Open Market Committee and Jerome Powell and what did and didn't happen in 21 and 22, I am naturally reminded of one of my favorite songs and the lyric by yacht rock aficionado Toto. It's "Hold the Line, Love Isn't Always on Time." Whoa, whoa, whoa. Now, when has the Fed ever been
Hmm.
on time, to be fair, right? After
Hmm.
2004, in 98, belatedly, it seems, and I'll go back forever and look at the minutes in early 2007, and it was a garden variety kind of housing slowdown, and no one could ever tell that this Minsky moment was coming down the pike, that you had all this kind of subterranean toxic assets, risk taking, leveraging at Bear and Lehman Brothers. It's not like you guys are omniscient.
Uh,
And I know it was a lot in
so I'm
that
not a
question.
guy
There's a lot.
anymore. I'm not that flimsy guy anymore. I was then.
Yeah.
So I think there's two things to say. First is that you have to be careful about an ex post perspective. In real time, you're thinking, all right, it could be the case that 3 years from now, I'm going to think I should move now. It could be the case that 3 years from now, I'm going to think I shouldn't move now, right? And then 3 years from now, you realize which universe you were in, which parallel universe
These
you
are
were in.
kind of the Rumsfeldian known unknown knowns, right?
Yeah, kind of. And so in hindsight, you're always going to look slow, but in the moment, there was always a case for, uncertainty about just what path you were on. So that's an important qualification. Second thing is about about 2008. I mean, the Minsky moment. I mean, things were tracking okay until the fall, and uh, you've got Lehman, then you've got AIG. So after that week, there were six large financial institutions that had failed. And the way the government had handled them was five different ways. So there was Fannie Mae and Freddie Mac. They took them into conservatorship, so took them over. They repaid some of the debt. They didn't repay the stock, right? They didn't
Yeah.
fund that. Preferred shares that a lot of small banks held. There was, what there was
No,
IndyMac,
there were bank
there
failures,
was Bear
IndyMac. They were all
Stearns,
very different
Fleeman.
interventions, and we had no
Right.
playbook for Lehman specifically or AIG. They were all different.
Well, here's the thing. It was clear that the program was uncertain. It would be nice to clarify it. It would be nice to tell people, here's the set of institutions that are too big to fail that we will rescue. We will rescue them up to this point in the capital stack, but not any further. So preferred shares, are
Or
they
get
in? Are they
wiped
out?
out. Yeah.
Subordinated debt, are they wiped out or not? Here's our policy. But they've done six different institutions, five different ways. It was going to be hard for them to issue a statement that was credible. And, you were going to wonder where are they going to get the resources. So the Fed had interest rates at positive levels then, around two, and it had run out of treasuries to sell to sterilize these interventions. So for the
Mm,
Fed to lend, it had to sell treasuries or else it would inject too many reserves and drive the funds rate down. So given the funds rate target, it was running out of
right.
treasuries to sell. The Treasury didn't have the legal authority to lend money, so they turned to Congress and asked for $700 billion. Now that was a tough sell. Large financial institutions weren't that popular.
Of course.
Appropriating that much money to rescue the investors in those institutions wasn't popular. Hank Paulson and Ben Bernanke had to scare the bejesus out of legislators to get them to do it.
Yeah.
But in the process, they scared the bejesus out of everyone else in the economy. I think that's what froze things.
Full Disclosure Podcast to NPR, Spotify, YouTube, Apple, all of the podcatchers. And yes, we have videos, including this one on YouTube. I'm trying my hand out there, having just recently only left MySpace and Netscape, or that's a Gen X quip. You don't have to laugh with me. I appear every week on CNN and NPR's Here and Now. You can follow us on Blue Sky, on Instagram. The handle is Roben Farzad. And you can catch all of these links neatly stacked at fulldradio.com. Again, fulldradio.com. Please follow, recommend us, rate us, call your mother-in-law, do the works. And my DMs are always open. And a shout out to our radio listeners on WVTF Radio IQ, the great Commonwealth's NPR news station. Holler if you would like us on your air. If you're just joining us, my esteemed guest is economist Jeff Lacker. He's former president of the Richmond Fed, and he's now a member of the Shadow Fed, which is like, what is that, like Dungeons and Dragons, like cosplaying?
No, this is an organization that was established in 1973. It's a small, loose collection of academic economists and former Fed officials that follow the Fed closely and are steeped in monetary economics, understand as best the science lets us how these things work. And the shadow part comes from this tradition in British politics of the opposition party forming a shadow cabinet
Oh,
to critique what the in party in powers cabinet is doing. So it started in '73 at a point where inflation was ripping and out of control, and the Fed deserved criticism. It was deflecting blame for inflation. It was claiming it was due to oil prices and unions, but it was really, at the end of the day, at the doorstep of the Fed to control money growth. The shadow is very influential. It met twice a year, still meets twice a year, and issues statements and position papers. And it had a big influence on the thinking in Wall Street and Washington that led to Paul Volcker's appointment as Fed chair and his decision to control monetary aggregates more tightly in order to reduce inflation in the early 80s. And
And
so
let
they,
and let me timestamp that for people. I go off and I give these presentations. My coming of age moment. We came from Iran in 1978. Dad, circa 1981, 1982, took me to the Savings Bank of America in Florida, and I remember there were blenders and toasters and food processors and a penny arcade and all these signs advertising savings accounts of 15, 14%. And dad proudly took a knee and gave me this passbook savings account. And I mean, they were like, they could give you, you want wheat pennies, you want $2 bills for the tooth fairy. It was like this great place. And meanwhile, I lost my dad last year, but I tell my son and the
sorry.
world, I tell my son and the world this story. I mean, it was a time of breaking the back of inflation. The Fed had taken
Yeah.
rates to the teens.
Uh-huh.
Um, Oddly enough, that was the perfect time to invest in the stock market, which went on to
Yeah.
have a record
Yeah.
18-year run, specifically when the Fed was trying to mop up excess cash from the
Yeah.
system.
Yeah, so equities got really pounded in the late 70s when inflation was rising because the tax code distorted,
Yeah.
corporate tax decision making and margins and led to a lot of funkiness. But yeah, they came around, after getting inflation down, that reduced a lot of distortions in the economy
But
caused by
isn't it
inflation.
interesting? I think about it back then. It was the province of, brokerage commissions were still very expensive.
Yep.
You didn't really have people talking about Vanguard index funds. You had to call a 4 o'clock thing. You'd have to wire money. It's
Yeah.
nowhere near where it is today, which is kind of
Yeah. Very
frictionless
liquid.
for
Yeah.
better or for worse. The
Uh-huh.
brokerage commission is dead. You have all of these different ETFs that represent bonds, treasuries. The amount of
Hmm.
liquidity and ease of access is really mind blowing. For me, when I think about coming of age in that moment, like, here's your
Yeah.
passbook savings account. You're going to college in
Uh-huh.
15 years. Hold on to it.
Yeah, the capacity of the financial system to innovate in the United States has been tremendous. I mean, people complain about it, think of it as a gambling house, but it's been really good for American consumers over the last several decades, and it deserves attention. Those toasters aren't going to come back, by the way. They were a product of a regulation that limited the interest rate that savings and loans and banks could pay on deposits, and so they competed by giving gifts like toasters to their customers that
Jeff, I
brought
got
new
the
money in.
best blender. I think Hamilton Beach is based here in the greater Richmond area. They don't make blenders like those anymore. They
I
don't make
know.
toasters like those anymore.
Yeah, yeah, they were bulletproof.
You should
Yeah,
see what they fetch on eBay. I digress as I normally do, but I got to ask you while I
right.
have you. And I was thinking back to that moment to start 2023, which, coming out of this rate hike cycle, I think the Fed took up rates by nearly 5 points
Hmm.
into this inflation. I believe I saw that three of the four largest bank failures happened to start 2023 in the spring of 2023. Now, if
Yeah.
somebody had pulled you aside that New Year's and said this is going to happen, you
Hmm.
might think that there'd be an office glut complex or some toxic asset thing. This was literally because of an
So things.
embarrassment of riches. This was literally because
Yeah.
people had too much cash in their accounts.
Well, so here's the story. It's a little tricky.
Tell me.
So there's I'm going to talk about two things. So the first thing is the way banks account for their asset holdings. So if when they buy a treasury security, the normal way you would think of them accounting that is that when the value fluctuates, they take that on board and they recognize the loss or the gain involved. But the banks are allowed a separate account called held to maturity, in which they have to stipulate that they're never going to sell them. And if they do that, they can keep them at par value.
You can
Now,
keep them at 100, a
yeah,
100 cents on the dollar,
exactly.
100%, even
Right,
if the market suggests that they're down.
right,
Right.
right. Now, so that's the backstory here. 2021 interest rates are at emergency level. The Fed has to raise them dramatically to, over 5%. That means the interest rates on Treasury securities go up dramatically, which means their price goes down. And so a lot of these Treasury securities were underwater. Now, the ones in this held to maturity account, they don't have to recognize them. So they can publish accounting statements
We're
that
good.
say,
Our
hey,
our
we're
balance
good.
sheet is great. We took no hit.
Balance sheet's good.
Right.
Right. Now, there's this kind of cliff effect. This is another weird wrinkle of the regulations. So if you sell, if you're forced to sell something that's in your hold to maturity portfolio, like say you really need the cash, like depositors are withdrawing their
Keep or
money,
break in case of emergency.
right? Well, then you have to recognize all of them, right? You have to recognize all of the capital losses.
Now
And so,
pause for a minute. We are in a hyper echo chamber environment with Twitter, with social
yeah,
media, with
yeah,
by the way, access on phones. Like you saw that anecdote in the Wall
yeah,
Street Journal when everybody was on a plane in the West Coast, and just the mere rumor that a bank was not good for its money or that it
yeah,
had
they
misallocated
all,
these
yeah,
treasuries. People can move cash. You've done it
yeah,
on Venmo, you've done it on a Wells Fargo app, on a B of A app,
yeah,
and that could cause an immediate rush on the bank. You don't need a
right,
it's a wonderful life type situation. Zuzu
yeah,
pedals. How am I gonna? This happens on a phone, and it
right,
happens with. There could be short sellers casting aspersions on the
yeah,
credit worthiness, and so
uh-huh.
in real time, you saw very liquid, very capable banks suddenly fail in a matter of days.
So yeah, that's an important point. But picture this: imagine the same numbers, scaled up, applied to Citibank. No one would think Citibank's going to fail. No one would think you're going to have trouble getting your money out of Citibank.
Because it's understood
Citibank
that
was rescued. Is
Citibank
too
is a
big to
too big to
fail.
fail bank,
Right.
right?
So
It was
who's too big
rescued
to
in
fail?
'08.
Right. So who's too big to fail? Well, nobody says. None of the regulators in the Washington
Yeah.
state who's too big to fail and who's not. So it's murky. What you have to go on are past precedents. So there was an announcement, there was a statement in hearings in 1984 that the top 11 internationally active banks were too big to fail. Then in 2009, there was a program called SCAP in which there were stress tests on the banks, 19 biggest banks. That went down to regional banks that were about 200 billion in size. And if they didn't have enough capital, the Treasury would offer them capital. Or, well, let me put it this way: if they didn't have enough capital, they'd have to raise it privately. If they couldn't raise it privately, the Treasury would inject it privately.
Of last resort.
Right. And the flip side of that was that if they did raise it privately, the Treasury wouldn't force them to take it. And that was really important because if you're a private investor, you're not going to invest if you think the Treasury is going to come in and dilute you
Yeah.
afterwards. So it was like the all clear. It's like, if you guys can raise this privately, we'll stay out of your hair. And that's what made it go. Well, that size group, right? The top 18 or 19 banks, if you scale them up, it's about 200 billion now, a little over 200 billion in 2023. These three banks were on the edge of that. They were a little bit outside that
So
group.
time out. Were they not susceptible to the stress test that came out of 2008, 2009, right? Where somebody would have to come in, a regional bank or whatever, the Fed's regulators and the various assortment of people, and actually, worst case scenario, check the situation. If there is a run on your bank and you have these special securities in that vault where you don't have to recognize the losses and you have to tap those, if then, this is what I couldn't believe, that how was this all happening in
Yeah.
real time without the Fed at the helm?
So regulate. So the supervisors were aware of this. Staff at the San Francisco Fed, and they were on course to force the bank to fix it. But time ran out, and this run happened before they could get to that point. Um, more broadly, there's a regulatory regime for the largest banks, and then if you think about, $100 million bank, that has a couple of branches in your hometown, there's a much lighter regime for that because the risks are smaller. And then everything scales in between. So it's called tailoring, that the rigorousness of the regulatory regime varies on the way down. Now, the theory there is that you can let $100 million bank fail. It's depositors, they have to do some paperwork to get their money out. Maybe they have to wait a couple days. Um, that's one thing. But here they were right at the boundary here. And then what happened is the Treasury came in, the FDIC, and they wrote a memo called the systemic risk exemption that let them just put money into the bank and pay off the depositors. So they effectively guaranteed all the deposits. And these were uninsured. These were like higher than the deposit insurance limit. So they effectively wrapped them with that memo, all three of them, and then they said basically we're probably going to do this for everyone else this size.
And
So
it was a perilous moment. We were worried about a systemic crisis. I mean, many people don't remember it now, but this is how the spring of 2023. I think it was very much instructive in that even CFOs, even risk people at banks didn't quite understand the peril of not matching maturities to kind of depositor behavior in a kind of a worst case scenario things. You had really prestigious banks, Silicon Valley Bank, others, and the net result coming out of it is that these too big to fail banks, the massive, JP Morgan's, B of A's, and others only became stronger as they were able to come in and buy
right,
these banks with their,
yeah.
stalwart
Well,
balance
it's
sheets.
yeah. So SVB as a bank made some missteps that week, and
Right.
generally the plan is you raise capital and then you announce losses. But they kind of did it backwards, and they just before they had
And it's
raised the
brutal
money
for the
to
misstep.
re
You were absolutely taken out and shot. That's why, with
yeah.
the ecosystem of short sellers and skeptics and the echo chamber of millisecond market stuff, it's not even like, crash of 87 stuff where you would tune on to
Mhm.
Financial News Network or CNBC. But in the 10 minutes or so we have left with you, I have to ask you about the present, the here and now. Why is it that in this environment where consumer sentiment is taking a dive and people are fearful, you're still hearing about the frustration of getting people to show up for job interviews and for vacancies, especially in hospitality, especially in restaurants? Like, what money are these people still tapping for everyday expenses and to cover their nut? I think that the interventions of 2020 and 2021 are far in the rearview mirror.
That's a good question. Even after even before 2020, this was a constant refrain that we would hear from businesses in the Fifth Federal Reserve District, the one that the Federal Reserve Bank of Richmond is the reserve bank for. It's a district that extends down into the Carolinas, up to Maryland, out to West Virginia. Firms were telling us that it was really hard to find skilled people. They'd hire kids. They'd show up one day. They'd leave. Now they were able to find good kids, and there are places where there are good youngsters that show up and do their job, but they just found a hard time doing it. People that weren't passing drug tests, for example, particularly out in West Virginia, just as the whole opioid crisis was starting to break, we were hearing from employers that it was hard to find people suitable to hire. I think we dug into this, and our research staff has done a great job, and we visited places where they're doing much better at as a school system, as a county or so, um, provide of training a workforce for tomorrow. I think historically the America's catching up from a period in which college education dominated the thinking of high schooler, people who are running high schools and middle schools.
Yeah.
So as a middle schooler, you're about to go into high school, and what you see is a system set up to get you into college if you want to go to college. And if you don't want to go to college, it sort of doesn't have much for you. At least that's what was true when I was a kid. So you can forgive them for like goofing off and not really paying attention in math class. But in other countries, the non-college track is a much more robust thing. They get
Germany's
much
always
better
been
training.
cited because you've had
Yeah,
these small,
exactly.
medium skilled firms, the Mittelstand, and internships if you wanted to be a
Internships. Yeah,
craftsman.
exactly.
Here in the
Yeah.
United States, at my impression, it's always the province of, you'd stay up late, watch UHF TV, and they go, Apex Tech, come out and learn how to become a car
Yeah, it's
mechanic, and
privatized.
we'll
Yeah.
pick you up. And a lot of
Yeah.
these schools were not reputationally, you take out debt, they were not very certified. There seems
Uh-huh.
to be a second thinking right now about cutting to the chase, not taking on the debt
Yeah.
of a 4-year liberal arts degree.
There's a huge movement to beef up our technical training. So we visited a place, Asheville, North Carolina.
Yeah,
Now
I
you
know it
think of
well.
that as a retirement resort place, serious manufacturing agglomerations there. And the technical schools, the vocational technical schools are world class. They're great. I mean, they get ex GE engine plant guys to go teach at the tech school. So they have a culture of preparing high school students much better. And there's more we could do with community colleges, for example. There's more we could do to rationalize kind of the tech certificate world. I know Senator Kane, for example, has pushed sort of granting, sort of providing servicemen with technical certificates that are portable, and recognized in the real world. So I think that's an area we really need to invest as a country, and would be wise for us to
And
do
here, one of
so.
the regional executives we have in common is Tom Gaynor, CEO of Markel. I every now
Yeah.
and then I try to meet with him at nearby the Westwood Diner, the
Uh-huh.
Westwood Pharmacy, and he made it a point. It's always instructive with him that you notice how long it took to get a table and how long it took to get our order.
Yeah.
In addition to the prices on the menu, that itself is a form of inflation through our time.
Yeah.
The fact that people
Yeah.
cannot be hired, it's seat yourself. I know the owner of the place. He's been so
Hmm.
eager to get people to show up and do this. I think of that kind of almost as another axis of inflation is your time.
Yeah.
Whether you're at an
Yeah.
airport or you'll see in a hotel now, they don't have enough people to change the beds every day.
Yeah.
So they'll ask you if you want to variabilize that. But two,
Yeah.
I wanted to ask you about shrinkflation. How does anybody measure that? I mean, I go into McDonald's, it seems like a McNugget is like half the girth that it used to have. Or
That's funny.
look at a filet fish. I mean, it's
Yeah. Yeah.
real. It's really nefarious behavior because I'm clearly paying more
Uh-huh.
for less. But is anybody accounting for that per unit?
Well, it doesn't sound that nefarious if you're so aware of it. But yes, the Bureau of Labor Statistics does a first class job of making sure that the product they're measuring the price of
Apples to
now
apples.
is comparable, yeah, and adjusting for quality as best as is humanly possible. So that's now I'm not sure they're measuring McNugget size, but maybe they're weighing it or something. But I
Well,
wouldn't be surprised if they
I
are.
mean, everybody's complained about McDonald's inflation and fast
Hmm.
food inflation, and that's
Yeah.
been that and gasoline. I mean, the things you see at the grocery store, the less for more. I can go back into the archive on eBay and get you a bar of Dove soap, family size versus what it is today. I mean, all sorts of complaints. But when you
Yeah.
see literally corner cutting and
Hmm.
literally that you're paying more for it, you have to be mindful of another plane of inflation.
Yeah. No, inflation's corrosive. It leads to incentives to play these games with products and product quality and the like, and it's not a good thing, and we need to keep it under control. The Fed's in a really tight spot this year, and it has its hands full, even without tweets from somebody.
One question on that also about inflation and wages is there has to have been a chilling effect on, I mean, with immigration. And yes, the border might be more calm than it's been in a couple of years, but I hear again anecdotally that um, Mexican Americans, Central American workers, South American workers, even ones with in transition are getting their documentation, are afraid to show up for job interviews now. It has to have a chilling
Yeah,
effect when you're having a
yeah,
crackdown on people. And I
yeah,
wonder how that
yeah.
then ports to wages.
Well, so sort of a little known fact the last couple of years has been that the surge we saw in immigration uh, allowed the labor force to expand more rapidly than it otherwise would. And that helped contain inflation, at least in the short run in 23 and 24. That tailwind has turned into a headwind now for the Fed. So it's not, you know, it, uh, it means that employment growth is going to be harder to achieve. Any given level of growth is going to be harder to achieve. It's going to be associated with more inflation.
And in closing, I have to ask you, Jeff, for the few minutes I have left with you, it's the meaning of life existential question that I pose to my influential high school economics teacher, Mr. Lutness. Um, you know, I entered the workforce. I took a brokerage job in 1998 when I entered college. And I've seen all sorts of waves and things being normalized. And we used to talk about moral hazard, and we used to talk about emergency rates. We used to talk about the peace dividend. We used to talk about the small cap premium emerging markets. Everything waves and cycles come and go. And every night I ask myself, what, pray tell, is normal? Was there ever a time in your life when the economy was kind of at a benchmark normal, where you didn't have rates too high or too low, inflation too high, too low, where we weren't at war, where there wasn't some extraordinary thing such as COVID happening or a fight between the White House and the Federal Reserve. Is there even such a thing?
Uh, what- What's normal is that things don't seem normal right now.
Yeah, but coming out of the crash of the global financial crisis, there's a new
Yeah.
normal. What is normal?
Well, I mean, on any given dimension, you can think, all right, is the labor force, what's going on in the labor markets? Is inflation back to target or not? And there are times where it's close to target and times where it's not. There's times where employment the labor market is as healthy as you could expect given what it's gone through. But the recent past is a tremendous weight. I mean, in the financial crisis, you had millions of workers thrown on the labor market from the residential housing construction sector and supporting sectors of building supplies and the like. And the economy had to absorb them. It had to somehow figure out, all right, where are they going to work? And so that meant finding the industry, like where's the now nobody's explicitly doing this as a giant, AI mind or anything, but what the system is finding its way to through a lot of decentralized decisions is where are they going to find work? And so we got to create firms, we got to move capital there, we have to invest in the firms that are going to be the next thing to use the willing workforce that we had in 2010 and 11 and 12, for example. So I think that process of adapting to recent disturbances, recent unexpected developments, I think that's constant. Things keep changing. What you don't want is, you know, it's just bad. It shoots us in the foot to throw a monkey wrench in it and change things, in a way that's not really constructive.
Can you see
So
around the corner with this tariff and Fed impasse right now?
no, I mean, I think the Fed's gonna sit on its hands for at least until the summer. I don't think any of the data until the reports that come out in June or July are going to be very informative because the change was so dramatic. And I think, it could be some months after that before you get a sense of how strong a surge in inflation you're going to get, whether there's, growth effects are large, which one predominates. And even if growth dampens, it's not obvious that makes you want to cut interest rates because the question is always demand versus supply. So if supply falls and if demand falls, but supply also falls, you might want to keep interest rates where they are. So I think they're going to keep powder dry until the fall.
Jeff Lacker, former president of the Richmond Fed, senior affiliated scholar with the Mercatus Center at George Mason University, and a member of the Shadow Fed. It sounds like the best like emo band you've never heard of. I wonder how you guys meet. Is it on Zoom now, or do you go in like some
Yeah,
subterranean place? Is it like Skull and Bones?
no, we mean like our public meetings are in Washington, New York, so we're above board. We're not in the
Do you do
shadows.
cigars in the Vulcarian mode or like Rumsfeld pipe? Like how does it even work with you?
No, no, no. We're a nerdy group, so
Jeff Lacker,
none of
thank you
that.
so much. You are always welcome on this show. Grateful to know you.
Oh, thanks, Robin. Yeah, great to know you. Thanks a lot. Thanks for having me on. Enjoyed it.